Hey everyone, welcome back to Clipping Coupons with Jennison Associates. My name is Alex Chansky, and I'll be your host of the show. Today I'm hosting Dimitri Rubin, who has been on the show before and is head of structured products here at Jennison Associates. Last time he was on the show, Dimitri and I spoke about the health of the U.S. consumer. Dimitri, great to see you again.
Alex, very good to see you. And the consumer market and the mortgage market are related, so we're sort of approaching some of the same topics and questions, but very excited to be back.
Wonderful. And Dimitri, could you once again give us a brief 30-second introduction about yourself and the work that you do here?
Yeah, so I'm now about 25 years into my investing career. I think after 25 plus or years, you just say 25 plus. You stop mentioning the years. I've been at Jennison for about 6 years, and I oversee everything that we do in structured finance, which includes sort of consumer-related sectors, it includes certain kind of more corporate-related sectors, it includes agency mortgages is a very important part of it. But anything that is within kind of the securitized space, I look at together with the team.
Fantastic. Okay, thank you so much. So yeah, ready to jump into things here. As head of structured products, I know you look at kind of a variety of asset-backed securities and mortgage-backed securities. Today we want to talk to you a little bit about agency mortgage-backed securities, agency MBS. Starting with the broad question here, as investors, why do we care about the agency MBS market?
Yeah, I would say we should care both as investors and as kind of voters and consumers, because it's a market that's really a crucial underpinning to the U.S. economy and also how people live. So to explain why we care, the first reason we care is it's a very large market. The agency MBS market is about $9 trillion, which makes it the second largest market globally after U.S. Treasuries in the fixed income and the bond space. The market offers a spread above Treasuries. So it is sort of a sector where you're able to earn some spread while also having a guarantee from the government-sponsored enterprises, which then themselves have a guarantee from the U.S. Treasury. And that guarantee is implicit or explicit, so something we'll come back to and talk about a little more. And then from a consumer perspective and the economic perspective, the agency MBS market provides the largest source of financing for the U.S. housing market, which is itself absolutely crucial. So that market today, the value of U.S. homes is about $30 trillion, which is an enormous number to think about, with about 65% of U.S. households owning their home and most of them owning it with a mortgage, with the agency market being the largest source of that funding.
Perfect. And then one level deeper into this then, can you tell us a little bit about how the agency MBS market works?
Yeah, so the U.S. mortgage market is actually quite different from how it works pretty much anywhere else in the world. We have the advantage of having the 30-year mortgage, meaning that when the consumer takes out a mortgage, they basically have a payment that is laid out, a flat payment for 30 years as principal and interest. And the interest rate of that does not change. Now, in order to do that, there's a bunch of things that the capital markets have been able to do and innovate in the United States to make that possible for the U.S. consumer. That mortgage is also prepayable at any point. So on any given day, if that consumer decides to move or they decide that they don't want to have a mortgage anymore, or importantly, if they find that they're able to borrow money more cheaply, they can simply prepay that mortgage, whatever the principal is, and be done with it. What that means is it creates prepayability or rate incentive. If you take out today a 6.5% mortgage, let's say, and tomorrow rates are 7.5%, you probably are not looking to refinance that into a new mortgage. On the other hand, if tomorrow rates are 5%, well, now you have a positive rate incentive, meaning that you could take out a new mortgage at 5% with a significantly lower payment and pay off your mortgage at 6.5%. And the primary risk that we as investors take in the mortgage market, it's not credit risk because of the guarantee from the government-sponsored enterprises, Fannie, Freddie, and Ginnie. It is this prepayment risk. It is this idea of negative convexity, which is that if rates rally, meaning interest rates come down, the borrowers are likely to prepay in larger number than otherwise.
Okay, great. So then that segues in really nicely to the next question I have here, which is going to be about the government-sponsored enterprise guarantees. So Ginnie Mae mortgage-backed securities typically offer explicit guarantees, while Fannie and Freddie have implicit guarantees. Yeah, do you want to talk to me a little bit about the difference between those?
Yeah, this has been in the news a lot recently, and for many people, this is a new topic. For those of us who are sort of lived through the '08 cycle, this is sort of a repeat of something that brings back a lot of memories. But to understand, Ginnie Mae is part of the U.S. government. Its debt is explicitly guaranteed by the U.S. government. Fannie Mae and Freddie Mac are private entities historically, which, however, had something which was called an implicit guarantee, which is they were not guaranteed, but there was an understanding that they were so important to the U.S. government that the market treated them as if they were almost guaranteed. When 2008 came and the companies ran into trouble because home prices dropped and they had higher losses, we tested that guarantee, and what in fact happened was the U.S. government put the entities into conservatorship, meaning they wiped out the equity and they guaranteed the debt through a swap line from the U.S. Treasury. And that's where things have now been for almost 20 years. And part of what is happening today with the Trump administration, there's a path forward. We're recording this on August 14th, so some of the news is already out. There's a path forward to making the entities private again, generating some equities from that and so on. But that also means that the question of the guarantee and whether or not the guarantee will stay in place becomes really important, right?
Yeah.
So when we looked at this, we started thinking about this about a year ago, last August. And at the time, what we found was, the market wasn't really treating Fannie, Freddie, and Ginnie, right? One with an explicit guarantee, two without, any differently. And in fact, we could buy certain Ginnie bonds, which historically were difficult to source. They were being sold by some foreign buyers because of some technicals in the market. We could actually buy them quite cheaply, even compared to Fannie and Freddie. And so when we saw an opportunity to get same or better spread with potentially less risk around this issue, we took advantage of that and built up the position sort of through really the end of 2024. Mm-hmm. And so now we're starting to see the headlines come out. There's still a lot of uncertainty as to whether or not we're going to end up with a guarantee for Fannie or Freddie or not. But the way that we're thinking about it is if we're not getting fully paid for that risk, we would rather hold a little less than we otherwise would and not be exposed to the potential headlines while the mechanics of how the new entities are going to function are being hammered out. Because investors who bought this paper, particularly foreign investors, particularly banks, they definitely bought it with the idea that this has a government guarantee. Mm-hmm. And so any change to that can be pretty violent in the markets.
Okay, great. So it sounds like you were able to buy Ginnies at very similar pricing as Fannie and Freddie, with the idea that privatization might make Fannie and Freddie riskier, basically making the Ginnies worth more in comparison.
Absolutely, and that was certainly the case. It's gotten a little harder. That was certainly the case last year in 2024, right? Q3, Q4 of last year. We were seeing a lot more opportunities. It's gotten a little harder now because people are starting to think about this possibility a little bit more explicitly.
Mm-hmm. Great. So then I guess the next question for you after that is going to be about performance in the agency MBS market. How have these securities performed recently, and where do you see value in them going forward?
Yeah, so the agency MBS market, we're always thinking in excess return terms, meaning do we perform better than U.S. Treasuries? There's a certain amount of interest rate movement. U.S. Treasuries move with that, and we want to know, did we do better than U.S. Treasuries for taking this additional incremental risk? So the good news is year-to-date, agency mortgages have actually performed quite well. Within that, if we think about different coupons, and there's a conversation about borrowers with higher rates versus lower rates, depending on when they took them out, the higher coupons have outperformed. That has been sort of a good position for us, but it also means that there's less opportunity today than there was earlier. And to give you a sense for how the volatility compares and how we think about the world, in April, when we had Liberation Day and significant volatility in the market, you could go from February to May and say, well, how did this compare to corporates? And in excess return terms, corporates returned approximately minus 1.5%. and agency mortgages return approximately minus 0.5%. So that gives you a sense of kind of beta to the overall risk markets into a particular sort of risk-off event. If we look at it today, mortgage index looks historically fair to maybe slightly attractive to treasuries. And at the same time, the corporate sector looks quite tight to treasuries.
So the corporate sector is looking pretty expensive.
Yes, it is.
Historically.
Historically, it's looking quite expensive. And so there's this debate in the markets about, well, if mortgages are about fair to treasuries, should you still own a lot of mortgages because corporates are even richer? I think from our perspective, it's a little bit of a matter of degree. Right now, we think that mortgages have tightened to a point where only a very small overweight, very close to a neutral position, is prudent versus 3 to 6 months ago, the answer would have been quite different. But they've performed and they've tightened quite a bit. From our perspective, just the incremental spread doesn't make quite as much sense, and we like being positioned near neutral in certain situations. So if there is a shock of some sort, and they do come around occasionally, we're able to quickly react and have a lot of reserves.
Perfect. And then how does that fit into the past 3 to 4 years of extreme rate volatility?
Yeah, if you think about mortgages used to be a very boring product. And the last, let's say, 5 years, that's really not been the case. If we go back to COVID, again, we talked about the fact that mortgages have this prepayment component. Their duration sort of moves around quite a lot. We went into COVID, the Federal Reserve cut rates to zero and also started buying securities. So interest rates dropped to generational lows. You could get a mortgage at 2.5% to 3%. In that environment, many borrowers prepaid. Fast forward to 2022, inflation had picked up. The Fed started raising rates very quickly. So the assumptions about borrowers with a 3% mortgage and thinking, well, these people are sort of, maybe they'll prepay, maybe they won't. All of a sudden, the interest rate was 4, 5, 6%. And you went from maybe they prepay to, no, they're really not going to prepay. That's convexity coming in. And that can be quite damaging. If you think back to that period, that's when Silicon Valley Bank failed, and you had some fairly significant volatility in the financial markets around the idea that people who bought these securities thinking that they were going to be shorter into a very large interest rate rise found that they were owning longer bonds just as interest rates were going up and owning duration became difficult. So mortgages have been sort of, in some ways, a difficult asset class now for 5 years because interest rates went first very low and then very high. In that environment, we think it is an asset class that really does benefit from active management and thinking through the risk, so that one can take a step back and say, well, you know, the Federal Reserve is buying $1 trillion of these at prices which don't make sense to anyone else. Maybe we should own a little less than we would otherwise. So things like that, as simple as that, and some more complicated things that we're able to do, where we think active management in the sector has really proven itself out.
Sure. Great. And then I know you talked about this a little bit already, hammering into it a little bit more. Within the MBS market, is there anything specifically that looks attractive to you that you wanted to talk about today?
Yeah, so for this, you really need to think a little bit about, do you want your mortgages to prepay or not? And the simplest way to think about it is, if you take out a mortgage and some of the higher coupon borrowers with higher rates, those might be trading at a $105 price. If a borrower prepays, you get back par. So you lose that 5 points. At the same time, some of the mortgages issued in 2021, 2022, and even 2020, those are trading at an $80 to $90 price. Now, if a $90 price mortgage prepays, you get back par. You make 10 points.
And those are trading at a discount right now because rates have gone up since then.
That's
so
exactly
people are
right.
unlikely to refinance. Is that the idea?
They're much less likely to refinance.
Okay.
And so in the case of both of those sort of situations, what we think about is what are the market assumptions about future prepayments. This is a market where models and market assumptions really matter. And within that, sort of, what do we think is attractive? And if we look at it, again, early this year, we thought higher coupons at a small premium really made a lot of sense. There was sort of we thought that they were priced quite attractively, even when you factored in all the options, and the lower coupons were not. If you look at it today, it looks a lot more fair. You could still find some opportunities where you could own specified pools, which are pools of mortgages with specific characteristics to them that are put together, where maybe you're able to get a little bit better positioning versus just a generic. And that has to do with some things are just naturally faster even when they're at a discount. And some things are naturally slower when they're at a premium.
Due to some of the specified characteristics.
Due to some of the characteristics of the pool. So for example, borrowers with very low loan balances tend to be both faster when they're at a discount and slower when they're at a premium. And the reason for that if you think about having that interest rate differential between what you're paying and where the market is, that matters a lot if you have a $500,000 mortgage in dollar terms. If you have a $50,000 mortgage, it matters a lot less.
Okay.
Right? So as a result, you have sort of a better convexity, flatter S-curve product in mortgage speak.
Got it. So if there's a higher loan balance, you're more susceptible to changes in interest rate.
Yeah, you have a higher incentive to refinance in terms of the real dollars of what you're paying.
Yep. Okay. Understood. Thank you. And then is there anything else you wanted to talk about in terms of attractiveness of different mortgages?
I think we covered it. As I mentioned, and this doesn't make for the most exciting headlines, we think the mortgage market is kind of fair to very moderately attractive, and within the mortgage market, things are also kind of fair. In an environment like this, versus environments where we've taken very big overweights or underweights to different parts of the mortgage market overall, we think it makes more sense to be closer to neutral in the mortgage market and then be closer to neutral across different parts of the mortgage market. And wait for better opportunity dislocations to come in the future. So again, August 14th, maybe it looks one way. It might look very different 2 weeks from now.
Okay, great. Last fun question I have for you here. Because you've already been on our show, you've answered the question already about favorite books or movies. Do you have a good vacation spot or favorite place that you visited that you wanted to mention to everybody today?
Oh, well, I love to travel, so there's going to be a little bit of a recency bias because there's many places that we go that we really love. But we spent some time this past year in Prague. And that part of Central and Eastern Europe, Poland, Prague, was really, really fun. It was culturally very dynamic, and bringing this back for a second to the economics, which I'm always thinking about even as I'm traveling, it was very economically dynamic. It was very interesting for me to see the way that we're now 35 years removed from the fall of the Berlin Wall, the way that that part of the world now looks very much like Western Europe in terms of living standards, in terms of kind of richness of culture and so on. And that was really, in a world where we've had a lot of bad news geopolitically, that's I think a good news geopolitical story that doesn't get quite enough attention.
Great. Thank you so much, Dmitry. Really appreciate your time on here, and ready to wrap this up.